This is not like the 2008 global financial crisis, which, by the way, was a financial crisis. What we're in today is an economic crisis, and there's a difference between the two. It's not the 2000 dot-com crash. You have to go back to the Great Depression for the right frame of reference. And, we all know the stock market crashed in October 1929. It didn't hit bottom until June 1932. It was down 89.2%. That's what a real stock market crash looks like without the Fed there to, kind of prop things up. But then ask the question from the bottom in 1932, down 89.2%. When did it regain the old high? When did it get back to the 1929 high? The answer is 1954. It took 25 years to get back to that level. Now, it doesn't mean you couldn't make money. If you bought the low in 1932, you could ride it back, although we had another recession, 1937, 1938. But it took 25 years to regain the high. That's the right frame of reference. I grew up in the 50s and 60s, which is a very prosperous time in U.S. history. I did not live through the Great Depression, but my parents did and my grandparents did. So I was raised with a kind of depression mentality, even though we weren't in a depression. We used to save the rubber bands off the newspaper because, why would you throw them away? And we, as 9-year-olds, we went out with our wagons and we went door to door and we collected tin cans and newspapers. It wasn't for environmental reasons. We were recycling things that could be turned into airplanes and battleships. I mean, that didn't change until the late 60s. It was the late 60s when the baby boom came of age, and it was, rock and roll, party on, credit cards and, mortgages and leverage and all the rest. That's when we left it behind. But that was 30 years from the 1930s to the 1960s. The effects of this are intergenerational. So, the V-shaped recovery, I always says, was nonsense. The idea of the V-shape goes down steeply, up steeply, and we're back where we were. That didn't happen. It went down steeply. It started up steeply, which is to be expected, but then it truncated, flattened out. And that's where we are now. In fact, I would say we're actually in a recession now. This will be the first back-to-back recession since 1980, 1981. We can spend more time on that if you like, but we didn't come all the way back. So it's like falling into a 50-foot hole, climbing out 20 feet. Okay, nice job, nice climbing, but you're still in the hole. And that's where we are. And so again, the effects of this will play out until the 2040s in terms of adaptive behavior. Let's say all the restaurants reopen. They're not, by the way. But let's just say hypothetically they did. Doesn't mean people want to go out for dinner. I mean, people are scared. Airlines get back to normal. It doesn't mean you want to fly. I mean, again, these are intergenerational behavioral changes that are grossly underestimated. I had to just roll my eyes when they started talking about pent-up demand. As soon as I heard pent-up demand last spring, I thought, okay, this is green shoots again, back to 2009 with Tim Geithner's green shoots. But there's no pent-up demand. I make the point that during the first lockdown, the quarantine, kind of March, April, May 2020, I stayed home. I didn't go out to dinner, but my wife and I usually go out to dinner on a Friday night. Well, the restaurants didn't reopen until June, but we didn't go out March, April, May. So let's say in June we go out to dinner. I didn't order 9 dinners. I had skipped 9 Fridays, but I didn't order 9 dinners. I ordered 1 like I usually do. So no, that was a permanent loss. There's no pent-up demand for 9 dinners just because you can go back out again. Maybe seem like a trivial example, but apply that to the economy, airline tickets, rental cars, hotels, resorts, dinners, bars, etc. There was no pent-up demand, and half these businesses are gone. They're just gone. So that's the situation we're in. I say it's a little worse than that, actually, because we're probably in a new recession right now. So here's the notion. The notion is markets look, 6 months forward. They see what's coming. They apply a discount factor. They discount it back to the present value. And markets efficiently and smoothly incorporate all the information and reflect where things are going to be in 6 months. And you can't beat the market, so don't even try. That's efficient market hypothesis in a nutshell. Well, markets do look forward, and they always get it wrong. They always get it wrong. They did not see the dot-com crash coming. They did not see the 2008 financial crisis coming. They did not see the pandemic. I talked about it in my last book. They did not see the 2020 crash. Markets always get it wrong. Now, that doesn't mean fight the market, because that's a good way to lose money, but they discount the wrong future. That's probably the best way to describe it. So what are markets saying right now? Well, they're saying, okay, here come the $2,000 checks, and that's correct. There's going to be another $2 trillion of deficit spending in the next few months. People are going to get $2,000 checks, and they're going to take those checks and run right out and buy a new car, refrigerator, carpet the house, whatever. This is going to drive consumption. This is going to drive the economy higher. It's probably a little bit inflationary, and interest rates have to go up. And they are going up. 10-year yield to maturity has gone from like 90 basis points to, I think it's about 110, 115 basis points today. So, and that's bad for gold because gold has no yield. Oh, gee, 10-year notes are going up in yield. So give me the 10-year notes because I'll take the higher yield. Got it. There's one problem with that, which is that interest rates, they might go up a little higher. I wouldn't rule that out. And then they're going to get slammed. They're going to go straight down. This has happened. Just look at a 10-year chart of yield maturity on 10-year notes. This happened like 4 times. And by the way, every peak is lower than the one before. It used to be, got to 2.5, crushed, got to 2.25, crushed. Now, I don't know, 1.5, whatever, pick a number. It's going to get crushed again. The stock market and the real economy have never been more detached. Now, obviously, the stock market not only recovered its losses from the February to March 2020 collapse, but it's beyond that. We're at new all-time highs. Okay. But that's not the real economy. Just to be more specific, we had the S&P 500, so-called. Well, it's really the S&P 7. We know who they are. It's Facebook, Google, Apple, Amazon, Microsoft, Tesla, and Netflix. Those 7 stocks are 40% of the S&P 500. It's a cap-weighted index, and the market caps of those companies are so big. They are 40% of the index. So they go up. They're the least affected by the pandemic because they're technological. They're not, bricks and mortar, et cetera. They're streaming, they're online shopping, and so forth. So they're going up. So what happens? People are passive investors. They're buying index funds. So more money comes in, they go up some more. More money comes in, they go up some more. And look, I'm not saying short the S&P 500. That's like standing in front of a 18-wheeler going 70 miles an hour. You're going to get crushed. But it does have bubble dynamics and has nothing to do with the real economy. Let's flip over to the economy. What is that? Small and medium-sized enterprises. So all these Wall Street mayors, they look down their nose at, your local restaurant, bar, nail salon, dry cleaner, boutique shop, etc. The small and medium-sized business are 50% of all jobs and 45% of GDP. You are crushing it with these lockdowns. You are killing that sector of the economy. You can't kill half the economy and not expect a recession, which is what we're doing right now. By the way, the pandemic data, which we have, I use the Johns Hopkins dashboard, which, like everyone else, and it's very reliable. The caseload compared, so go back to last March and April, that was, everyone remembers how horrible it was. The caseload is 10 times greater, not twice as bad, 3 times as bad, it's 10 times greater. The fatalities are more than double. So this is far worse than what we experienced last March and April. Governors and mayors are doing what they always do, which is locking it down. It doesn't work. We already talked about that, but fine. You lock it down. Who's getting locked down? Not Amazon, not Apple, not Costco. It's the bars and restaurants and nail salons and boutique shops, all the places I mentioned. But it's half the economy. And these businesses, they don't have $5 million of working capital. They make money. They pay their bills. There's a little profit for the owner. And actually, we have data on this in terms of working capital for small and medium-sized enterprises, depending on whether the particular enterprise, it's somewhere between 30 and 90 days of working capital. That's what they have. Well, that was gone last summer. And so now, it's not a question, you'll come back, we'll change the rules. No, they're gone. They're bankrupt. The storefronts are vacant. They're up for lease. The equipment's on sale at fire sale prices, and the employees are home, and they're not even unemployed technically because they're not looking for jobs, because why would you if you're a bartender and all the bars are closed? So that's where you have to look at labor force participation rather than the unemployment rate. I'm not saying the government lies or makes it up. I'm sure their statistical methods are fine, but you have to understand what they are. Labor force participation is back where it was in the 70s. In other words, it's close to 60%. It never gets to 100. That's nonsense, because there's always good reasons for some people not to be in the labor force. You're a homemaker or a student or, retired early, whatever it might be. But 70 is high, 60 is low, and we're right around 60, right? 60%. So there are at least 10 million able-bodied people between the ages of 25 and 54 who don't have jobs but are not counted as unemployed. You put them in the unemployment numbers, you have depression levels of unemployment. So that's where we are. So stock market, knock yourself out, as we used to say in high school. It was a popular song, knock yourself out, but it's not the real economy, and people have to understand that.